Hello and welcome to the Daily Brief, where we cut through the noise to bring you the most important stories that move the markets. I'm your host Tarun. Today is Tuesday, August 13th, and I've got 4 big stories for you. You can find us on Spotify, Apple Podcasts, and other podcast apps. And if you like reading instead of watching or listening, you can subscribe to our crisp newsletter for a quick rundown. You can find all the links in the description. Before I begin, I wanted to say that the Olympics came to an end this weekend, and what a fun couple of weeks it has been. India won 6 medals. A big congratulations to all the Indian athletes who gave it their all. Now, let's start with the stories. I first talk about the drama between SEBI and Hindenburg. I will then move on to the key points from the recent MPC meeting and why the RBI governor is worried. I will then talk about the inflows into mutual funds, and finally, I talk about how India might get more money. So let me first start with the drama between SEBI and Hindenburg. Short sellers are like the janitors of the stock market. They identify fraud and clean up all the craziness. If you are new to the markets, short sellers are investors who bet on the price of companies falling. That means they sell first when the price is high and then buy back the shares when the price is low. As important as short sellers are, not all short sellers are angels. In fact, a few weeks ago, the Securities Exchange Commission, which is like the SEBI for the US markets, imposed a $20 million fine on a famous short seller for trying to defraud investors by making misleading statements. Now, over the weekend, the noted active investor and short selling firm Hindenburg Research was in the news because it made several shocking and sensational allegations against the SEBI chairperson. Now, I want to make it clear that the claims made by Hindenburg are exaggerated claims and there's no evidence. In fact, the SEBI chairperson has issued a detailed clarification debunking the claims in great detail. I'll get into this later, but before that, let me give you a timeline of this very entertaining saga. Hindenburg first made news in January 2023 after it published a shocking report on Adani, alleging stock manipulation and accounting fraud. This led to a dramatic fall in the stock prices of Adani companies. The stock prices of Adani companies fell anywhere between 20 and 80%, but recovered all of their losses by June 2024. In March 2023, the Supreme Court ordered SEBI to start an investigation to probe the allegation made in the report and also to determine if there was a manipulation of share prices. By 2024, SEBI had completed 22 of the 24 investigations and submitted reports to the Supreme Court. These reports are not yet public, but people soon forgot about this drama until early July this year. Hindenburg was back, and this time they disclosed that SEBI had sent them a show cause notice over violations of disclosures and unfairly profiting from short positions by making misleading statements. But nothing happened after this until last Saturday. On 10th August, Hindenburg made several allegations against the SEBI chairperson. Hindenburg alleged that SEBI chairperson Madhabi Puri Buch and her husband had stakes in offshore funds linked to Adani Group. They further highlighted possible conflicts of interest, such as the SEBI chairperson's involvement with these offshore funds and her husband's advisory role at Blackstone, a major REIT investor in India, and how the regulations around REITs have been changed. By the way, all these funds were invested through IIFL. Both SEBI and the chairperson responded to this. SEBI urged investors to stay calm and think carefully before reacting to Hindenburg's reports. On REITs, they said that any changes to the rules are made after careful discussion with experts, the industry, and the public. On the chairperson's conflict of interest, SEBI mentioned that the chairperson has been transparent about her financial interest and has stepped away from any decisions where there might be a potential conflict of interest. SEBI chairperson said that their financial dealings and investments were made long before she joined SEBI, and they have been transparent about their finances, fully disclosing all relevant information to SEBI and tax authorities. They argue that the allegations are baseless, motivated, and aim to discredit SEBI and attack Madhabi Buch's character. IIFL, meanwhile, said that the fund had no stake in any of the Adani companies. As I mentioned in the beginning, short sellers are not always knights in shining armor and have often engaged in shady practices to make a profit. Now, let me talk about the RBI policy meeting that took place last week. The RBI kept the repo rate unchanged at 6.5% for the 9th consecutive meeting, and this was widely expected. So no big changes here, meaning borrowing costs will stay the same for now. Why did they decide this though? Well, the RBI is playing it safe because they're keeping a close watch on inflation, especially food inflation. Since November 2023, food inflation has constantly remained above 8%. This matters because food and beverages have a weight of 45% in the overall CPI inflation basket. So if food prices are rising, that means headline inflation will continue to rise. This is why CPI inflation has remained above the RBI's target of 4% for most of the year until this month. But the fall this month is because of the base effect, because CPI inflation in June 2023 was 7.4%. The RBI is worried about this because when food prices rise, it affects everyone. Imagine going to buy your favorite snacks and realizing they cost more than last month. No fun, right? The RBI knows that high food prices can really squeeze our wallets, so they're monitoring this closely to make sure things don't get out of control. So until the RBI is sure that inflation will remain under 4%, interest rates will remain unchanged. In his recent policy meeting speech, the RBI Governor Shaktikanta Das explicitly mentioned this. He said that high food inflation affected household inflation expectations, meaning if inflation continues to remain high, people will continue to expect it to remain high. This could lead to an increase in wages and the cost of living, both of which will lead to companies increasing the prices of goods and services. All of this will lead to inflation increasing and remaining sticky. Now, this wasn't the only important thing the RBI governor spoke about. In his speech, he made several important observations and announcements, and I'll unpack them one by one. Last month, the RBI governor pointed out that there's a big gap between credit growth and deposit growth and called for a reasonable balance between these two. He reiterated this again in the policy speech. He said that alternative investment avenues are becoming popular, and because of this, banks are losing out on deposits, which are growing at a slower pace compared to the rate at which banks are lending. He warned that if this gap persists, it can expose the banking system to structural liquidity issues. By alternative investment avenues, the governor is referring to mutual funds and debt funds. He is concerned that these investments have become more popular than bank fixed deposits and has asked banks to innovate to attract deposits. The RBI has long been worried about the crazy growth in unsecured loans after the pandemic. At one point, unsecured loans were growing at 32% year on year, and now the growth has moderated to 28% year on year. The governor said that the measures undertaken in November 2023 to make it costly for banks to give personal loans are working. But the governor said that certain segments of personal loans are still growing at a high rate. He said that some people are taking personal loans for consumption purposes, and this can be a macro problem. It's not just personal loans they're concerned about. The governor also mentioned home equity loans or top-up loans, where you borrow extra money on top of an existing loan, like a home loan, and other collateralized loans like gold loans. The RBI has noticed that some banks aren't sticking to the rules when they give out these top-up loans. Now, considering the RBI has been cracking down on everything from KYC to underwriting, as we have seen in the cases of Paytm, Bajaj Finance, Kotak Bank and HDFC Bank, it seems like some regulatory action against lenders that give top-up loans on houses and gold is on the horizon. Finally, let's talk about some exciting changes with UPI. The RBI has some good news. First, they're increasing the limit for UPI transactions when it comes to paying taxes. Right now, the limit is 1 lakh rupees per transaction, but they're bumping it up to 5 lakh rupees. This means that if you need to pay a big tax bill, UPI has got you covered. But wait, there's more. The RBI is also introducing something called delegated payment through UPI. This is a pretty neat feature. It means that you can now allow someone else, like your kid or family member, to make UPI payments from your account, up to a certain limit, without them needing their own bank account linked to UPI. So if you're busy and need someone to pay a bill for you, they can do it directly from your account. This is going to make digital payments even more flexible and convenient. Let us now discuss the rise in cash inflows for mutual funds. The mutual fund flows data for July came in last week, and domestic investors are still super bullish on the markets. In July, investors put in 43,000 crores, This was a slight dip compared to the 45,000 crores in June. For comparison, MF flows at the same time last year were just about 9,400 crores. The pace of inflows into mutual funds this year is stunning. So far this calendar year, the net equity inflows have been 2.4 lakh crores. For comparison, this number for the first 7 months last year was just 80,000 crores. The flows have been supported in large part due to strong SIP flows and money going into new mutual fund schemes or NFOs. Let me start with the SIP flows. On average, the gross SIP inflows have been about 20,000 crores, but the net SIP flows are about 8,500 to 9,000 crores. The popularity of SIPs has increased phenomenally over the last 4 years. The inflows into new fund offers or NFOs are stunning. This calendar year, new mutual fund scheme have raised 51,700 crores. For comparison, this was just about 17,800 crores last year. People have gone crazy for new thematic schemes that target themes and sectors like defense, manufacturing, energy, and tourism. Nothing tells you it's a bull market like people going crazy for investments. Mutual fund flows are one reason why the Indian markets have been so resilient this year. Now, along with the mutual fund flows, you also have equity flows from Provident Fund, National Pension Scheme, and insurance companies. All these automatic flows have steadily grown in size and are an indication of the deepening of the investor base in the Indian markets. Now let's talk about how India might get more money. India might soon get a lot of money from foreign investors. Why, you ask? See, foreign investors look at broad indices to get an idea of how much to allocate. One such index they look at is the MSCI Emerging Markets Index, which consists of 24 emerging market countries like India, China, Brazil, and Taiwan. The bigger the country weight, the more the money that flows into those countries. India's weight has steadily increased from less than 10% in 2020 to almost 20% thanks to the stunning bull market we've had. Analysts are now predicting that India's weight will rise by at least 1 percentage point following the MSCI's review this week. This would bring India almost on par with China, which currently accounts for 22.33% of the benchmark. India lags at 19.99%. That means, according to one estimate, this will lead to an inflow of more than 9,500 crores into the Indian markets. And that's it for today's episode. We'll see you in the next one.